7 years ago, when I started Forex trading, there's a strategy I remember that clearly changed everything for me. I was making $2,000 monthly with this strategy, and nobody seemed to be talking about this strategy here on YouTube. I think now is the right time for me to tell you about that strategy. I know when it comes to strategy, we have two factions of people: indicator-based guys and then the price action-based guys. And there's always a fight, a tussle between the I want you guys to keep an open mind. Whatever strategy I'm going to be sharing with you guys definitely will make you a lot of millions. As long as it's making you money, it's definitely making sense. Now let me head straight to the trading station while I sip my drink and share this strategy with you guys. Super excited to want to show you guys this strategy that makes me $2,000 back 7 years ago when I started trading. And I'm super pumped to share with you guys that this strategy is Relative Strength Index, popularly called RSI. So RSI is an oscillating indicator that moves from 0 to 100. Oscillating indicators are just like your grandfather wall clock. It's always rotating from 0 to 100. Whenever you get to 1 point, it moves to the another one. All right. RSI is also used to spot divergence, and RSI can also serve as an overbought condition and oversold condition. These are conditions that whenever market gets to this point, that means price reversal is imminent. That doesn't mean it would always happen, because sometimes price can get an overbought and still keep buying. It's just a potential buy or sell signal at those points. Let's head straight into the video. Let's get into the PC so that I can explain to you how to add RSI on your trading view chart, and then you can start using it to make money ASAP. So the first thing, when you hop on your trading view, the first thing you would notice that you should have a clean chart, and you want to come on this indicator right here. Indicators. Upon getting to indicator, you can just type as easy as RSI. You can just write the full name, Relative Strength Index. It's the exact same thing. You want to click on this first one that come out at this technicals. So it will immediately be added to your screen at this bottom. All right, so this is the default settings. So the first thing I want you to do, I want us to play around with the settings, which obviously I will want to be using the default setting. I want to tweak it a bit so that it can fit whatsoever I want to do right now. So you want to come on input. The RSI length that I want you to use is turn it to 7, because I want to be picking trade from 15 minutes. One very key thing about RSI is that people get to tune it depending on the type of market that you're trading. So if you're trading a very volatile type of market, you may want to extend the oscillating, the overbought and oversold condition to 80 to be overbought and 20 to be oversold. But in this video, I'm going to be using it in GBP/USD, which is like a normal market. So I'm going to be using 70 as an overbought and 30 as oversold. And then my RSI length is going to be 7. And then the moving average, which I'm going to be using here, I'm going to change it to exponential moving average, which is EMA. And I also want to change the moving average length to 7, because I'm going to be taking trade off of 15 minutes. This system here works like crazy. It works magic. So what I want to do, I also want to change the styling. I want to change this thing so that you guys can see clearly. I want to change the moving average inside to red, and I'm going to be leaving the RSI, the line there, as purple as it is. All right, so I mean everything is pretty nice, everything is fine, looking nice, and I'm just going to tap on OK, and then we're good. Now let's head straight to how it works. RSI compares the recent gains and losses in an asset over a specified period of time, usually 14 days in daily charts. This time we set ours to 7, so it's going to be 7 days in a daily chart. It calculates a ratio of average loss and average profits within a specified period of time, and usually the number is between 0 to 100, and then you put a dot there, and then it connects from the previous one that it comes from. Then that's how you connect that long line that you see in between them. That's how it works. How traders use RSI. This is one of the most interesting things, and I want to explain to you guys, and I also show you how I do use it that make me to make $2,000. But before I show you that, let me take a sip. It is used for overbought condition. It is considered overbought whenever you get to 70, and traders get to want to take profit when you get to 70 or consider selling at that point. And it's also used as oversold. Once it is oversold, traders want to take their profit there or consider going long. These are the two ways that most traders do use it. Now let's head straight to the computer screen again so that I can show you how exactly I do use them that made me to profit $2,000 in a month. The first thing I want to do on this screen right now is to toggle on the settings button, go on input, scroll up, then you can take a screenshot of my settings so that you can have exact setting that I have. Go on my style, I'm going to scroll through up so you can have exact same colors and settings that I also have on mine. And then go to visibility, and then these are the exact settings that I have right now. So and then when I'm done, I'll click on OK. So you should have exact same thing I have on my screen right now. Then I'm sure you guys already have my psychological level all around your screen. So there's nothing really spectacular here. I only have just psychological level. So now let me just focus a lot more on this indicator, explain it a lot more, and then I will delve into giving you about 3 good examples, and then you can go on and do your due diligence and search. So you guys will notice the first line you'll notice here is this broken line. This broken line is at 70. So this is our overbought line that we've been shouting. And then there's a median line, which is 50. All right. And then there's the 30 line, which is our oversold line. And then with God, if you keep going down, we have the 0 since an oscillating indicator, and then we have 100 being the highest. So oscillating indicators are basically indicators that move from 0 to 100. So they keep fluctuating to the highest price, and which is 100, and then 0 being the lowest, and that barely happens. So it's usually rotating between, say, 30 for oversold, 70 for overbought. So whenever price is trending RSI line, it is this purple line I mean. Whenever this purple line is trending above this median line, then that means we are in a short-term uptrend. All right, if it's on 15 minutes. Then if it is beneath it, we're in a short-term downtrend. So it could also be used to determine like a mini trend in that regard. But please kindly note, RSI or this indicator, oscillating indicators, shouldn't be used as an analysis indicator. Instead, it tells potential entry points. Okay, it just tells you that imminent entry point, and doesn't mean that it's 100% accurate. This can be about 90% accurate. So that's why it's very important you apply proper risk management to whatever strategy you're using, whether it's an indicator based or it's price action based. Since that is already established, let's head straight to the examples and let's use this thing to see if it actually do work. The first instance where I want to make this to work is using it as an oversold condition. You guys notice that price went out of range at this point, right? Immediately price went out of range, all right? You can see it shows some red. That shows that it's an overbought situation. It went way below 30. So whenever price go below 30, you don't just go in and start buying. No, you want to wait for it to curve and start coming across this red line, which is the moving average 7 exponential that we just had said. And immediately it crosses it. The candle that makes it to cross is this bullish candle, right? So let me go ahead and put a vertical line so that we can be rest assured that it's a very strong indication to either go long or to go short. So price happened right here. It's crossed. So immediately price crossed right there. That shows a long entry indication. So from here, you should have a very good entry now. On this vertical line, immediately price gets to this point, then you should be having a long entry already in your mind. So on this long, upon the close of this candle, so you hop on for a buy and you put your stop loss on the recent low, and then you just target ×2 of whatever you're risking right there. So ×2 of this trade would mean that you are risking 22 pips to target 44 pips. That easy peasy, right? That easy peasy. So the only thing, this is already a strategy. The only thing that you have to deal with is to deal with the tension that comes with waiting and the tension that comes with you trusting your analysis at the end of the day. So this just tells you a point of entry. Another point again where it worked again is another point here where we have oversold condition. An oversold condition did really happen. Remember I told you guys that not every time I get oversold, overbought, that it would always work, right? So let's say we got in on this oversold condition upon the close of this candle and it's crossed and then this candle closed. Now let's do that practical example. I'll be very factual so that you guys can know the win rate and the losing side of this whole strategy, right? It's very important you guys know both sides. Now check, when price crossed, it was on this red candle. So let's say someone who would have gone in for a sell would have been in at this point, all right? On the recent high, you're risking 20 pips to target 40 pips. And that's how you'll be losing your 20 pips in this case, because 40 pips would mean that you need to get here. This is 41 pips here. So you probably would have only been able to make, say, around 20 pips one-to-one. So this is one point where it fails. Notwithstanding, this is where this new concept I'm about to explain to you guys is going to help you, which is what's called divergence. What is divergence? RSI divergence is a situation of the market where there's a discrepancy between the price and then the RSI. The RSI will be saying you should sell, and then you kind of saying you buy. So that doesn't mean one of them is wrong. It's just showing that at that time that is the discrepancy, there's a particular turn that is going to happen, and this is what you should do when that happens. It's also a way to get into the market at that time. There are two types of divergence. We have bullish divergence and bearish divergence. Bullish divergence occurs when the RSI makes higher lows while the price of the asset makes lower lows. In other words, RSI shows strength or momentum increasing while prices continue to decline. This is often seen as a signal that the downtrend might be losing steam and a bullish reversal on the horizon. And then we have the bearish divergence. Bearish divergence occurs when RSI makes lower highs while the price of the asset makes higher highs. In this case, RSI indicates decreasing strength or momentum while prices are rising. Bearish divergence can be a signal that the uptrend might be weakening and a bearish reversal could be approaching. Let me show you what that means on chart. First thing, in order for you to do this, to toggle on this setting is pretty simple. Just come on this place over here, click on the settings icon, and then you are going to toggle on this button that says show divergence, and you click on OK. So you immediately notice that there's a divergence that is going to be hovering around all our chart right now. Can you see? This is showing that it's a very divergence. You'd notice that if we are to delete this vertical line that I added here earlier, and we're going to add the one that tallies with what we have right now. First, let me go ahead and favorite this vertical line so that we'll just easy pick here and all of that. So let's start from where this is at. So we have one there, and then we have another one where it stops. For this example of a very divergent, so we are having price show it is low, and then this is high, but it's moving from high to low. They are saying two opposite things. In this case, that doesn't mean that the candles are wrong or the indicator is wrong. No, it's only showing that there's soon going to be a weakness that's going to turn to the downside. How you trade it is, anytime you see things like this, you want the RSI line to cross the moving average line right here. Once it is crossed, upon that candle, you want to go short on top of that candle. And so the candle where that happened after seeing this divergence is obviously right here on this one, right? It happened on this bearish candle, on this pull-up, or maybe on this pull-up. So you're expected to want to go short right here, all right? And you target 1 to 2, obviously. Again, use the highest candle, which is 18 pips times 2. So you want to do times 2 of that. Okay, that's another way to have that done. Then there are a couple of places where we saw divergence, and it usually really work. I've done bearish divergence. So let me do an example of a bullish divergence. Here's another one again. Price showed that there's an exhaustion. The sellers were getting exhausted. Then there's a bull run that's going to be imminent pretty soon. So this one has, in fact, two things that confirm it. Price crossed here, and then again, it also has divergence. So price was forming a low here, and then we have a lower low, and then this was like a low, and then this is a higher low. So from this point, it indicates that price was going to go up if I adjust these two lines again. So if you notice where it stopped right here, and then this other one started right here. They are saying two different things. The indicator is saying that price is going to go up. Meanwhile, in the real sense, price was actually coming down. So once you get to a strong level, and then price cross here, there's this red line cross. Let me zoom in. So and there's a red line cross of the red line. After this, you've seen a divergence. Then boom, another confirmation that you should go long again. All right. Let me go far back in price. Always remember that whenever you put your stop loss on the recent low, in target times 2 of whatever you're risking. Let me do more example for the buy. So we have another one right here. This is a low, and then this is a higher low, right? And then right here we have it started from here. So this is an example where it didn't work. So I want to be very real. So this is a low, and then this is a lower low. It didn't really so much work. But then if you look at it, if you are scalping, you know that it did really work in a sense. It did work if you are scalping, but then this is a short-term move. I wouldn't be advising you to want to take this. So that's why it's important that you don't allow this to be as a standalone indication to either go long or short. So if you're using the recent low is somewhere about 5 pip. So you should be targeting 10 pip, of which it delivered way more than 10 pip. We delivered 10 people. So, but then I don't want to be focusing on short scalp. But just know that this really works. Since we're on 15 minutes, you should be expecting things like this. So here's another example where the RSI overbought did really work. So it went overbought at this point. So as it was crossing back down again, and that point where it did work. All right. So you can use either one. You can start focusing on using it as a divergence most times, and you can just start using it as indication for overbought and oversold. But please kindly note, this thing shouldn't be used as a standalone indication. All right. You want to either merge it with your knowledge of price action, or you can also merge it with, most importantly, support and resistance, which is also a part of price action. But do not use it as a standalone indication. There must be at least 3 things telling you to buy before you want to go in on a buy, or telling you to sell before you want to go in on a sell. So this is just a simple concept I was using to cash in on this. Please, I want you to go back, follow this exact step that I followed. I do not take my words for it. Back test them, and then you come back to the comment of this video and tell me how much you're able to make within a month of consistently following your risk management strategy and following this sewing strategy. If you like this video at this point, please kindly smash the subscribe button, like this video if you have already subscribed before now, and then let this video be recommended to as many people who also want to be making $2,000 every month whilst they are learning how to trade forex trading. In summary, relative strength index and RSI divergence is a very good toolkit for a trader, most especially if you are a technical analyst. But please, it shouldn't be used as a standalone indication. There should be other toolbars which you are applying your RSI with. Example like support and resistance, demand zones, supply zones, and the way I have psychological level on my chart. You could also be applying it with moving averages or just one other thing, act as an extra confluence with your buy or sell signal. And please, it shouldn't be used as an analysis base. Instead, it should be used as a signal point. It only tells you this is a potential buy signal, a potential sell signal, and then you should follow it through with a proper risk management. Any strategy will definitely make you money in as much as you have a proper risk management, money management to back it up, all right, and trade management. So I'm telling you, this one actually made me money, and it definitely can also make you money. Just keep trusting the process, keep grinding. To other intermediate traders out there, make sure that this is the last stop strategy for you to start making profit consistently in the forex market. Until next time, yours faithfully, Jeffrey Benson, signing out.